Hello everyone, welcome back to Rise Finance. In today's video, we are going to talk about growth and value stocks and how each are defined. Let's check it out. In our previous video, we spoke about market capitalization and how that defines the entire stock market into mega, large, medium, small, and micro categories. Every stock in each of these categories can be further categorized into two, growth or value type. Before going into a deeper understanding of growth and value stock types, we need to understand a few key terms. One, earnings per share, in short called as EPS, which is how much money a company makes for each share of its stock. It is defined as a company's profit divided by the outstanding shares. This indicates how profitable a company is. Let's say a company A makes a profit of $250 million in a given quarter and it has 500 million outstanding shares. So that company's EPS for that quarter is $250 million by 500 million, which is 50 cents per share. Price to earnings ratio. In short, this is called as PE ratio. It is defined as company's share price to its earnings per share. In the same example, let's say the company's share price is $15 and the EPS, as we calculated earlier, is 50 cents. So the PE ratio would be $15 divided by 50 cents, which is 30. A high PE ratio could mean that a company's stock is overvalued, or else that investors are expecting high growth rates from the company in future. With these two terms defined, we can now term a growth stock as one that is expected to grow at a rate significantly above the average growth of the market. These usually have a high PE ratio, meaning they look expensive, but only justify if the company is growing quickly. If growth is not shown in the results, such stocks can see a rapid decline. Growth stocks tend to have a unique product lineup. Take, for example, Apple. Only Apple manufactures an iPhone and nobody else. If we talk about Amazon, it has established itself in the e-commerce so well that it is, for most people, the default place to buy something online. Now on to value side of stocks. Value stocks are those that usually trade at a lower price relative to its fundamentals. These tend to have a low PE ratio. Value stocks have share price lower than those in the same industry. Few value stock examples are Johnson& Johnson, Bank of America, ExxonMobil, etc. Why would someone buy a value stock if they may not see an increase in share price? Such investors attempt to profit from the dividends they typically pay. A dividend is a distribution of corporate profits to its shareholders. The amount paid out is determined by the company. They are usually paid out quarterly, but a few companies also pay them monthly. Investors buying value companies, most of which do pay dividends, just have to ensure they hold on to their shares to get the dividends paid. Growth stocks generally do not pay dividends, as such companies often reinvest profits back into the company to improve their R&D and make their products better. There are a few exceptions like Apple and Microsoft which do pay very small dividends. Growth stocks also tend to underperform when inflation is high, as the rate at which such companies borrow money is proportional to inflation rate. Commonly, the 10-year treasury yield is referred to as the borrowing rate. Higher the inflation, higher the borrowing rate. Let us look at this chart that shows the correlation between inflation and the 10-year treasury yield. Here we have data for the past 2 years for inflation and the yields. The blue line indicating the yield and the orange indicating inflation. So if you look at the inflation, it started at 2.5 at the start of January 2020. It dipped when the pandemic struck in March of 2020 and it went down, but slowly it started creeping higher and higher. It was in a moderate range till early last year in 2021, but then for every month we see it creeping higher and higher, 5.5, 5.6, and almost 7, and now 7.5 for January 2022. And if you look at the same graph for the yields also started low, then they started stabilizing, and then they slowly kept increasing higher and higher. Just like inflation kept starting increasing from March or April of last year, at the same point, even the yields began to increase. We can relate this graph with an ETF called VUG from Vanguard that tracks the growth stocks. So even they dipped massively during the pandemic, and from then they just kept rising and rising and rising, all the way giving almost 130% of returns by end of last year. And just as the inflation kept growing higher and the yields began to increase more and more, we saw a massive dip. If you look at the year to date numbers for the same ETF, we see it falling massively. If you have liked what you have learned so far, please click on the like and subscribe buttons for this video so that it can be suggested for many more like you. Financial services research provider Morningstar came up with a style box to categorize mutual funds. As per this classification, each stock can be placed into one of these 9 boxes. So say we go to morningstar.com and search for a company like Apple. And here, when you look at the investment style section, we know what type of stock it is. So Apple is a large growth stock, which means it's a large cap stock with a growth style. Likewise, if we search for a company like ExxonMobil, here we can see the company falls into a large value style of investment. So ExxonMobil is a large cap stock with a value style. There is also a category of stock as per this investment style, which are a blend between growth and value. So let's say if we search for a company like Procter and Gamble, we see the style of investment is a large core, so which is like a between growth and value. Procter and Gamble, which is a 150 plus year old mature company and owns brands like Tide, Bounty, Gillette, Pampers, etc., has its own unique market growth strength, but it's slow and steady. So, how did growth and value stocks perform in the near past? If you look at two ETFs that track value and growth companies, we have VUG for the growth stocks, and we compare it with VTV, which is for the value stocks. We see that in the past 1 year, the value ETF has performed fairly better compared to the growth one. So we see an 18% return for the values ETF compared to just over 8% for the growth ETF. This is mainly due to the massive fall in tech stocks since early this year. Tech stocks are mostly growth inclined and have dragged down the entire market. But if we broaden our outlook past 5 years, it presents a complete different picture. VUG outperforms VTV by almost 100%. Growth stocks are expected to outperform the overall market over time because of their future potential. They are considered to have a good chance for considerable expansion over the next few years, and so the share price is expected to increase quickly but with high volatility. They often have higher PE ratio, which is the reason for this volatility. The S&P 500, which is dominated by growth companies, often sees this volatile nature. Value stocks, on the other hand, are usually larger, more well-established companies that grow slow and steady and are considered to have a lower level of risk and less volatile. These are thought to trade below what they are really worth and will thus provide a superior return in theory. If we look at this graph that shows historical P/E ratios for the S&P 500 for over the past 10 years, we can see it has always been fairly low. So a PE ratio of below 20 is considered good. So we can see all the way through early part of 2010, it was below 20. But then starting of 2015, I would say, is when the P ratios of the entire S&P 500 index kept on increasing because there was a massive growth in companies like Apple, Microsoft, Amazon, Facebook. All of these kept just driving up the P ratios all the way up to 40, which is like extremely high. And then there is see a fall in the P ratios because the market also had corrected, and then it kept on correcting, and currently we are seeing a value of 25, which is fairly decent. It is still high but not absurdly high. So what type of stocks should be in an investor's portfolio? Ideally it should consist of both growth and value stocks, but what proportion should these be? Answer to that depends upon the investor's time horizon and risk tolerance. Growth stocks, in general, have the potential to perform better when interest rates are falling and company earnings are rising. However, They may also be the first to be punished when the economy is cooling. Value stocks may do well early in an economic recovery, but are typically more likely to lag in a sustained bull market. When investing long term, an individual should combine both growth and value stocks for the potential of high returns with less risk. This approach allows investors to, in theory, gain throughout economic cycles in which the general market situations favor either the growth or value investment style, smoothing any returns over time. If they are buying individual stocks, investors should stick to fundamental investing principles or otherwise consider buying a solid index fund that takes a lot of risk out of stocks. I hope this video has been helpful for you in understanding the difference between value and growth companies. Thanks for watching. Please like and subscribe to my channel to keep informed about all such informative videos in the future. I am not a financial advisor, and all the content you would see in this channel is for educational and entertainment purposes only. Everyone should do their own due diligence before investing their hard earned money. Thanks. Bye.